So I'm going to leave it up to Christine to give you a brief synopsis of her background. Thanks.
Sure. So this is just a talk that has evolved over time because it's surprising to me how many people want to raise venture capital but don't actually understand how the venture capital business works. And you know, if you're looking at yet another sales call, it's important to understand, like, well, who's your client, right? Like, what are their motivations? What are they looking to do? You know, what are the things they're going to look for in working with you as relevant to their business? And so some of the background is I've primarily worked with early stage startups. I've worked for a few venture funds, which tended to do earlier stage, so seed and Series A. Most recently, I did a bunch of seed work when I was at first round. I left a couple years ago to go to Intel Capital. We have a worldwide portfolio of about 400 active companies across all stages. So, and actually about half of our investing is global. It's outside the US. One of the things that I do locally is I mentor and advise a couple of the accelerators. So 500 Startups is one. StartX is another one, which is the Stanford Accelerator. And for both of those, this is 90% a talk that I give to the entrepreneurs that are going through those programs so they understand how venture capital works and how it might affect them. So, and just so I know, like, who are the folks in the room? Are most people, are you angels? Are you professional investors? Like, what's the temperature?
We can do like
just a very brief,
brief introduction, name and where you're from and what you're doing.
Your firm is,
yeah. So let's start.
Okay. Hi, I'm Juliana Contet, and I work for the Canadian Consulate. So I'm a trade commissioner. So I support Canadian startups who want to come down here looking for investment. So I'm really not the investor, I'm more of the connector, and I work with the local angels and local VCs. Right. And then I also run a couple of accelerators here.
Cool.
Hi, I'm Andros Virg, and I'm doing something similar as Juliana, but I'm working for Estonia.
Okay.
So it's we have a Estonia. Enterprise Estonia Foundation has an office here in Silicon Valley, and also connecting our startups through the VC or angel funding opportunities here.
I know you.
we met them this morning, so we met.
Jesse Martinez, tech entrepreneur. 41 Ads is my startup, providing contextual media advertising using the conversations within video, and I also run Latino Startup Alliance, so providing a platform that supports the Latino tech ecosystem. And then I also run Spark America, which is introducing tech entrepreneurship at the public high school level.
Oh, great.
I'm Christina Barr. I write for VentureBeat, so I'm press. Primarily cover enterprise tech, but also just a really cool startup that's launching. So it's a bit of a mix.
And just so I know, is this a public conversation or a private one? Because I will modify what I say in this presentation. There's a little bit of snark through it that I would cut out if it was going first.
I won't quote you on anything that seems damning.
You know what? Because people ask for anecdotes, and I usually just throw them right out.
So also,
but I might be more careful.
So also the video will be public.
Yeah.
So.
Somehow that's not the same.
Okay.
Because the only people who go to the video are like the ones who actually really want the content, as versus scanning for their name in the press.
Yeah, exactly.
All right, what do we got on this side?
I'm Kathy Lego. I speak later on the round table. I've been a venture capitalist for 30 years and an angel investor and board member of tech companies.
All right, so this is completely unnecessary for you.
I worked with Intel Ventures when Les Videz and Alfred Miller.
Back in the day. Yeah, I don't know those. I don't know any of those. I mean, I would probably recognize the processor crunched under my heel, but that's about it. Oh, look, so fun.
Let's just say when I joined, 10K wasn't a race. It was the largest memory size you could purchase.
Right. All right, over here.
Well, hard to follow up on that. Vadim Slavin, co-founder of Startup Monthly. We organize all this, and pre-seed investment, raising a fund. I'm going to close it in a few weeks. Yuri will mention more about that.
Lilia Sherman, I advise both big companies and some very little ones, do some small amount of angel investing. Various other things, but those are the most relevant.
Dmitry Ufayev, managing partner of Synergy Innovation. It's a seed venture capital firm.
Evelyn Buchatsky, managing partner for East Labs startup accelerator based in Kyiv, Ukraine.
I'm Olga Bilkova. I'm partner with Evelyn, also from Kyiv.
Hi, I'm Magda Kowalska. I work for venture capital in Poland as Herron Ventures, and I run the Gamma Rebels Accelerator.
Great. This is a room full of accelerators, basically. Accelerators are similar, you know,
or
similar
someone
intent.
that works.
Okay, so I'm gonna modify the modified presentation a little bit as we go.
I'm Yuri. Kind of Vadim and I, we founded Startup Monthly as a ecosystem evolving and supporting organization, and we also run Monthly Ventures. It's a seed fund that invests in startups that participate in our accelerator or without accelerator.
Right. Cool. All right. So basically, the idea is, you know, what's inside the black box? Like, what are the basics about venture capital? And it does reach from here. Not great. So the other thing, and I think this is incredibly appropriate to this room, is, you know, how can you leverage the venture capitalists, you know, either as an angel for the companies you've invested in, or really as accelerators. You know, you in particular are going to need to leverage the venture capital community for the success of your companies that you've invested in. And in particular, there are a couple of metrics that, to me, are hallmarks of a successful angel. And one, of course, is, are you actually making money, or are you simply having fun and, you know, funding projects like on Kickstarter? But there's a metric that seed investors use fairly commonly, which is this follow-on financing ratio. And it was one of the things when I was at First Round that we were very careful to tell entrepreneurs when they were pitching us was, you know, for every $1 that First Round invested into a seed company, roughly $30 would follow it. And that's the kind of metric as an entrepreneur you want to hear. Like, your entrepreneurs really want to know, when you give them a dollar, and that might be part of, you know, $50,000 from the accelerator, or, you know, the value of some things you're doing, you know, what's the dollar value that they might expect to come after that based on the performance of other companies you have chosen to support. You know, and that's a hallmark of how good is your network, you know, whether that's the people at the accelerator or the mentors that you've, you know, brought in, the advisors you've brought in. You know, the angels are venture capitalists that you attract, because if you have a wonderful set of angels investing in your companies, each of those angels thinks about these things. They have their own networks that they bring to bear for the companies in their individual portfolio. You want angels that can bring in venture capital, right? If you're an angel, you need to be thinking about, how do I drive a lot of follow-on financing for my companies? Because I guarantee you, the companies that you choose to fund, they will not be their last funding they ever get. They're going to need more. And so if they're going to need more, one of the measures of your success will be, how much more? Does on average they only get one more round? Do they get 2 more rounds? Like, what are you able to drive through the power of your networks that you build? So getting to know how VCs work is relatively important. And like I said, this is the #1 risk for you, is that your company does not get follow-on financing. So you need to know your audience. And you know, I may make jokes about this audience from time to time, and I'm in the audience, so that's okay. It's like I get to make Italian jokes too. So get to know your audience, and depending on who you meet, they want to hear different things, right? Like, so what you tell Ron Conway and, you know, what you tell Arvind Sadani at Intel Capital, they're very different things. They are not interested in the same companies, at least not described in the same language. And certainly from a point of view of, you know, this is really hard not looking at my own slides. But as far as understanding what people are interested in, you know, we leave a lot of public breadcrumbs, right? So you can follow what I'm interested in a bunch of ways. You can see what I'm talking about on Twitter, and if I'm retweeting news, if I'm congratulating an entrepreneur on something they did, a launch or some financing they had, it might not necessarily be my company. I might just think that's a great space and be paying attention. So it's an easy way to see what I'm paying attention to. Same thing with my blogs. Like, if I'm talking about the conferences I'm going to, there's a good chance I'm interested in the types of companies that would be at that conference, or else I would not waste my time going. You know, same thing, whether it's, you know, the Instagrams, you know, look at Pinterest. So for example, I have a pin board that has all of the internet companies. that Intel Capital has invested in. You know, when I post a new one, it always gets posted there and it pimps out to Twitter and to Facebook. So, you know, because that's part of my job, right, is to promote my companies. In fact, that's probably the biggest part of my job is promoting my companies. So it's an easy way to see what am I interested in. And it's not just me, it's most investors will have some form of this, either as an individual partner or the firm overall will do it. I think it's easiest to get to know people individually in their individual interests, so I do recommend getting to know what individual partners are interested in versus just the firm umbrella. Because if you send me something that might be a good fit for Intel Capital but isn't for me, maybe I'll pass it over and maybe I'll just turn it down. But in no case will I simply say yes, right? And so when you map out the venture business, and you can see this is 500 startups because there are all sorts of pirate maps and things in here. So, so you can pretend you're pirates. So these are the basics that we're going to talk about today. And there's just too much vertigo for me to look from sitting down. So it's kind of a finance job. I always laugh, like when I register for a conference and I have to pick, like, you know, pick your category of work. Like, I guess it's finance. I don't feel like I work in finance at all. So understanding that, and then understanding how partnership works and why that might be relevant for you guys, and why you should care about it. And also, like, sort of what are the influences? Like, when will VCs take a risk? You know, when will they not take a risk? You know, what kind of questions should you ask? And again, this is, as an investor, this is you thinking about when is it the right time to match one of your companies to an investor that might be a good fit, right? Because sometimes it's just bad timing, sometimes it's a bad investor. Ideally, you can get the good time and the good investor. And then finally, like, what are some of the trends that do happen in the industry that might affect you, you know, as you're sort of trying to coach your companies to be successful? So, any questions, things that you are hoping I'll talk about? And if I don't have it here, tell me and I'll try to work it in. So again, it's technically a financial industry. These things in the box, I think, are real finance jobs. Venture capital counts as private equity. But to me, it's kind of this different animal. So to me, those other finance jobs, you know, they're kind of like this. You're looking at reams of numbers and you're understanding markets and market trends and growth rates and things like that. And you have a very focused, quantifiable approach to the market and to the investments you make. But this is what VCs want, right? We're looking for rainbows and unicorns, and you tell me this story and I get so excited that you're going to change the world. Oh my God, this is tremendous. And the other people that don't see it coming are idiots. But I'm gonna get you a check because I see the rainbow and I see double rainbow. It's all great. I will not sing Double Rainbow song. But this is, and to me, this is the difference between the mezzanine investor that funds that last round right before you go public and someone who gives a team of kids from Stanford with a prototype a check to, like, go actually hire people and get an office and see if anyone will use their product, right? That's the difference to me. The people you guys want shoving out of the accelerators, definitely the unicorn guys, not the spreadsheet guys. Well, yeah, I'd be really surprised if you got a spreadsheet guy. So some categories we're going to talk about. So there's two types of partners in a venture fund. There are limited partners that have money, and there are general partners that in theory are doing the work. Talk about that a little bit. We'll talk about some of the reporting things and how that rolls back to what choices they make in investing in companies. Again, it makes sense when you talk about it, but I think it's a black box to most people outside the industry. And then understanding investment profiles and, you know, what actually is an investment profile someone might have, like what questions should you be asking to look for fits. So this is the basic VC business model. We go out, and let's pretend for the sake of argument I was still at a partnership fund and not at a corporate fund, which is a whole different thing. But 90% of the folks you might talk to, they find folks to give them money. They ask for money periodically. It's called a capital call. They get management fees on that money. And when they get returns, they give people money back. And they'll stay in the business by raising more money again and again. So let's get a little detailed on that with my awesome Dave McClure style graphics. Again, so I really should redo this for a non-500 startups audience with maybe less cheeky. Although I do like my unicorn. It was Creative Commons license. So.
And they say people learn more when they're laughing. So
there you go. There you go. So in a venture capital fund, typically the way it works is, let's say it's a $100 million fund, just to make numbers up. You're going to get a $100 million fund, and you're going to get 99% of that from school endowments, very rich individuals with family offices, maybe some corporate pension funds. A lot of public pension funds have money here. So 99% of the cash in this venture fund comes from those guys. Only 1% is coming from the people you see on the website, the general partners, right? And they have to put in some for tax reasons, so it's active investing, not passive, all this stuff, right? So they have to put in some both for tax reasons and to make these guys feel like there's some skin in the game, right? So, and so what you'll often see is general partners that haven't made a lot of money yet often have very small funds because then they can afford the 1%. Or they will, sometimes a junior partner gets brought into some big Sand Hill Road fund and the partnership will make him a loan or her a loan against future income in order to make that 1% happen. But this is generally how money comes in to this process. And then, oh, I'll come back to this. And you don't take it all at once. So if it's a $100 million fund, the very common thing to do, and again, I'm generalizing because everyone's a little different, but it's very common to see someone will take 10% at a time. So, all right, so if you're making a $10 million commitment to my $100 million fund, you're going to give me $1 million up front, and then over time, I'm going to ask you for another $1 million periodically, based on how quickly I'm investing, based on how things are doing returns, and so forth. That is why part of the investment profile for a fund has to do with how quickly they're investing the money, because you set expectations with your limited partners about how frequently you're going to ask for more, right? So a venture fund that has told their limited partners that we expect we're going to do 3 capital calls in year 1 and 3 in year 2 and then 2 for that kind of thing, they can't then go make a whole bunch of investing in year 1 that they have not set expectations for, because they simply won't have the cash. Or they'll piss off their limited partners because they'll ask for things they didn't set expectations for cash flow, right? Because all of these limited partners establish what their cash flow is going to be, right? So you set those expectations when you raise the fund as best you can. And obviously there's, variation.
Can it be per transaction, per deployment?
You can, but that's not wise. So let's say you work for the Harvard endowment, right? So you work for Harvard and you've told me you're going to give me $20 million, to my fund, and I say, that's great, I'm happy to have you. You don't want to have to deal with me monthly, right? You would rather, I came to you twice, like you knew that twice a year I was going to come in, I was going to ask you for, $3 million the first couple of times. Like, you want to know what your cash flow pace is, because you've got to manage across all of your investments, what are the inflows and outflows of cash for your endowment, right? And so if I surprise you, you generally are not going to be happy about that. You also don't want the overhead of me coming to you every time I'm making a new investment, right? Because it gets a little too much like cherry picking, because what happens if I start coming to you and, well, you really like this one, but you don't like that one, so do you hold back? Like, there's this, there are things in the partnership agreement to keep you from doing that, but it's kind of a bad precedent to give you, like, usually we like to bundle it, right? So you'll get the quarterly letter to the LPs saying, hey, we've made, a quarterly letter will often say, here's the new investments we've made, we're very excited about them, here's a couple of exits we had, aren't we great? Hopefully you have some of those. Here's some exits we had, and oh, by the way, we're going to be sending you a check with these profits, and we're going to be asking you for your next capital call on these dates. And it is really smart to send a check with profit along with the request for the new capital call. It's all, again, and so anyone who's raising a fund, like, think about the strategy of how you manage your investors, right? Like, you want, like, I know for me, my companies that say to me, hey, Christine, we're going to raise our Series B, so glad you're in. You're going to come back in again, right? I'm so much more excited to have that conversation if it's accompanied with an update letter about, like, the 3 new distribution channels they just launched and, sales are up. It's the same idea. It is no different. So that's how the money goes in. money comes out. See, it's bigger. It's a bigger pile. No. So ideally, this pile gets bigger, and the profits are not split the same way that the contributions are. And this is hopefully the big money for the venture capitalist. Generally, and again, I am generalizing, generally the way these are structured is all of the principal gets returned, and once all of the principal has been returned, you start doing an 80-20 split on the profits, right? And what's great is, if you've ever heard of VC say, my fund's in the money, my fund's in the money means we've already returned the principal. And what's really exciting is sometimes you see VCs be in the money when they haven't even made the entire capital calls yet. So like it's a $100 million fund, they've drawn in 70 million, but they've already returned 100. Like that's the fund that only makes a couple of phone calls and like the next one's done, right? Because they're clearly gonna make money. And so you have a couple of different incentive implications here. One is if you are a $1 billion fund, you know, and you've heard things in the press about, you know, it's harder for large funds to get the same multiples on cash that a smaller fund can, right? So if you are a smaller fund and you have these guys with lower salaries, this 20%, this is their upside. They really care about this, right? And the larger funds that might have bigger management fee on this money, this is less important because they're making $1 million salaries, not $100,000 salaries, right? It is very similar to a startup where the CEO is making $85,000 a year so he can pay his mortgage and feed his child, but he's got a lot of equity he's counting on, right? So smaller funds are more like that. Typical management fee is about 2.5%, and this is, you know, office space and salaries and travel and all that. And we've talked a little bit about the incentive implications. Large fund, fee is a big percentage, or fee is a big dollar amount. The upside is less important to someone's total compensation at that fund. Smaller fund, they're really hustling because they care about the upside for your company. So I know I tend to have some bias for smaller funds because of that, because I know they're going to work a little harder. And as far as capital, we talked about that. And again, just sort of carried interest. This is the analog to if you've got a CEO that owns 30% of the company, right? This is the analog and inside the partnership. Like, what's your carry? It's like, so if someone has 30% carry, it means they're getting 30% of the profit that goes to the general partners, not the stuff that goes over to the LPs in return for their investment. Does that make sense? On carry? Okay. Any questions so far? Yeah.
In your previous chart, you had 99 and 1%. 1%, is it by law or is it common practice?
It's common practice.
The same applies to 18.
Common practice. I mean, there are going to be, and it's interesting, there are some funds that will vary these numbers based on performance. So, for example, there are some funds where, so let's say you're, I actually don't know who's been getting the best terms on their partnership agreements lately, but if you're a fund that's been very successful, you might say, okay, once you've got your principal and once you've got at least, you know, a 2x on your money, we're going to get actually 30%, and you're going to go down to 70% because the perception is that we are less risky, right? Or if you're a new fund and you're working really hard to like it's a first time fund and you're working very hard to get your first LPs, you might offer a better split, right? You might say, well, we're only going to take, you know, 10%, you guys can have 90%, right? So this is not written in stone, this is not legal, this is just, you know, most of the time this is about what you're going to see, just like the 2.5% management fees most of the time. You know, it might be 2%. Some of the big funds, you know, might do it lower a little bit, the smaller, like someone with a $10 million angel fund might do it the larger percent, right? So, any more questions?
But,
yeah.
But if the fund is really running a loss, what then happens?
Yeah, well, it's whatever is agreed to in writing. So these are 10-year partnership agreements. Okay. Most of these are structured, and actually I think, is it the next slide? It is the next slide, okay. If someone's not happy, typically the recourse is to walk away from the investment or sell it on a secondary market if they are permitted to in the partnership agreement. Right, so if you're a institutional investor and you have given, you know, your favorite venture fund $20 million, and they've called down, remember there's capital calls, you don't write 20 all at once. If they've called down, say 6 million, and they're performing really crappily, you could choose to not give them the rest, right? But you are probably going to walk away from that 6, right? It's like walking away from a house mortgage that's underwater, right? There's basically, you know, sort of analogies to, you know, actually I think residential real estate is a great analogy for a lot of venture capital. Does that answer the question?
Yes.
Okay. But hopefully you won't need to do that. Or I've seen people try to renegotiate partnership agreements, right? But that's less frequent.
But,
So,
but I think that in Europe and I think in our countries it's pretty hard to follow these rules, and that's why there are so few.
right. And again, these aren't necessarily rules; they are common practices, right? So, and again, and this is certainly how it works in the U.S. I've not done any venture fund establishment outside of the U.S., but to the extent people do any modeling in the U.S., this is what we do. So, how do VCs stay in business? So generally what people do is they start a new fund, and the most common practice is for a 10-year partnership. And that 10-year partnership, usually there's something like an LLC, and there'll be some, or LP, and there'll be something bundled in about 1 year. There's a couple of 1-year options to extend the life. Like say you've got, you know, some huge win, like you've got Facebook, but they pushed out their IPO, so you extend it for a year, right? Like you can do things like that. And there are actually all these subgenres, right? There are firms out there that all they do is buy the last assets in venture funds that are at the end of their life, which is an interesting business to do too. But anyway, so you say, yay, we've closed our new fund. We have $100 million committed, and it'll be drawn down over time. And generally what you'll do is spend 3 to 4 years finding new companies like that you're going to give your very first check for those 3 or 4 years. And then somewhere around year 3 or 4, depending on your pace, you're going to stop making new investments out of that fund you just raised. And you still have money left. You better have money left. But that money is going to get used for follow-on rounds so that you can maintain pro rata, so that you can support a company, you know, that's doing extra poorly, or sometimes put more money in the one that's doing extra well. And then usually the last couple of years or last year, you're just looking to get out, right? You're not giving anyone new money, right? And so what venture capitalists do is around year 3 or 4, they'll raise another fund, because you don't ever want to be out of the market. You need to always be in market writing checks. And so if you have used up your allocation for new investments out of that first fund, you better have the second one teed up and ready to go. Which is why sometimes if you see, sometimes you'll hear that a fund has really slowed down the pace of investing and they're having issues closing the next fund. It's not because they're out of money. Like they still have all this money, right, to do follow-ons. But they're trying to make sure, like, you know, trickle down their pace of investing so that they're never completely out of market while they raise the second fund. Because one of the things that happens is, again, common practice, not always. Typically, once you raise the next fund, all of your new money comes out of the second fund. You can't commingle, right? Because what happens is you don't want Ponzi schemes, where people in this fund are putting dollars into the crappy deals from the first fund, right? They have to be very honest about that. Or then this is the way you enforce some of that honesty, the intellectual honesty. And so,
can these be the same partners, or
yes, it could be all the same people, but often.
And in terms of management fee, like
usually the management fee when you have a second fund, often the management fee, there's a clause in your first fund that when you have another fund active, you'll ratchet this one down a little. But you do still pay management fee the whole time, typically.
Okay.
Right. It just goes down, so it's not going to be 2.5% forever.
Right.
But you want this fund, the owners in this fund want to continue to have an incentive for the general partners to keep supporting the companies and keep going to board meetings and helping them raise follow-on and helping them exit, like, you know, so that management fee is there for that, right?
Can I ask a question? Yeah. Is it the same for entrepreneurs when they go to investors, they need some sort of warm referral? for the investors to go to the LLPs to fill a fund, do they have to have like warm referrals to them, or is it, how does it usually happen?
Yeah, and I'm trying to
about that.
So are you asking about venture capitalists raising money or about entrepreneurs raising money?
Raising their funds,
okay.
yeah.
So there's two things. One, if it's an older fund and like they're on fund 18, right? They're probably just making a few phone calls and assuming nothing has gone tragically wrong with their performance, they're probably going to the same well they've always drunk from, right? If it is a new fund, it generally is going to have one of a couple of paths. One is to go to folks that they know very well, and maybe you have like an anchor tenant that you've worked with before, and like you flesh out around the anchor tenant. But a lot of young funds or first-time funds actually use professional fundraisers. So you actually go to a professional fundraiser that knows the people at Horsley Bridge and knows the people at Yale and, you know, CalPERS, and they make the phone calls and say this one's right for you and this is why, right? So, which is very funny, but typically VCs use brokers. Because we hate to invest in companies that use a broker, so
I know.
It doesn't make sense.
So it's not the same model, right?
No, it's not. And again, it's different, right? So for example, at first round, like, there were certainly going around with the pitch deck and the placement memorandum gets sent out and for the first fund, right? Because no one necessarily knows what the parameters are, what kind of deals are you going to do. Like, you have to teach people all that, right? And see if they're excited. But then the second one, it's much easier calling your existing investors, which is similar to, you know, a company that's doing well, saying to its existing, you know, board and investors like, hey, do you want to reinvest? We're going to do some more.
Do they usually scale the team as well? Because they need to be on the board?
It depends on the firm, right? And it depends on the strategy, right? So let's talk about this for a minute. So here, this is pretty common. And this is when people talk about the venture industry getting too big and too much money. This is what's happening. Because what happens is people raise fund one, and if fund one is, let's say it was 100 million, right? I'm just making numbers up, but say it was successful, they go out and like, wow, all of our existing investors want in, and we have a bunch of new investors, or some other people want to put in more than they did last time. So they raise a little more. And then it happens again. They raise a little more, right? Because people get excited, want to put more money in. So you keep taking this money in, which means you have to do one of two things. You will either make bigger investments, because the same number of people will manage those investments, or you will hire more staff, right? Or you will manage your investments less closely, which kind of might play with how successful you can be, right? Like if you say, well, so I'll be on 10 boards instead of 5, and, you know, but I'm not going to go to every board meeting. Like, you can't really do that, right? So, like, and I know that some of the seed funds, because in theory you get, you know, you could get on a board and stay forever, right? Until the company is exited, in which case you really have to manage your pace of investment, because you're thinking, well, the average amount of time is 5 to 7 years. That means I've got 5 years going back of boards I sit on, so I need to make sure that rolling number is manageable. The other thing you can do, and First Rep does this, is, what they'll tell people is, like, you can count on us for 18 months, and then after that, we generally would get off the board, right? That was the, and I believe that's still the practice that they have, just based on some of the investments I've done in their companies. So you have to say, okay, well, we're just going to do a rotation where we'll commit to this amount of time, and then after that, we're going to try to make sure that you've brought in other investors who are then carrying the weight of supporting you at that level, right? And I think people who do later stage investing would also expect to get out more quickly, right? Because you're closer to exit.
Right.
Right.
You talked about university endowments and etc. And I'm sure that they go with more traditional VC firms that have been in the market, have a track record, and so on and so forth. How do you raise your first money? If you're going to count on those, it's kind of hard. I mean, if you're just forming a VC company, who do you go to?
I will start again with professional fundraisers. Because most larger endowments, especially the universities, they don't want to have all of their money with, you know, Sequoia, Kleiner, August, you know, sort of the older, larger funds, right? They want to have some cash set aside for higher risk, right? Like, because if you're doing portfolio management, you spread your risk, right? Some are more conservative, some are less conservative. And even within alternative assets, which is where venture capital goes, there are levels of expected risk. And so often people will set aside money to a certain amount of cash will go into first-time funds or into women and underrepresented minority-led funds, for example, right? So actually, you guys, looking pretty good. You should have some good conversations when you go out. It's like, hello, ladies. I don't feel bad about that at all. The guys always get it anyway. So anyway, after, any more questions on this part that we talked about so far? Okay.
Related to something, so if I'm a company raising money and I'm ready to go to VC, how aware do I need to be of, did they just raise a round or
right.
sort of at the end?
That is a great question. I want to hold it for a minute because there's actually some conversation we're going to have about that. So you get like the $5 for the next topic. So what happens, all right, so we've got 3 or 4 and then you do number 2. And then another 3 or 4, you do number 3. And so since they're 10-year funds, that means after, 7 years in business or so, most venture capitalists have 3 funds in action at any one time, right? And in theory, by the time you get to number 4, this one's done, right? So it just kind of keeps going on and on and on into hopefully infinity if you've, built the fund 30, 100, whatever. The important thing to remember is, so someone says we have $2 billion under management, that means all of the funds. There's only one that's making new investments. The newest one is the one making new investments. These other ones are just babysitting, right? I mean, it still might be a lot of work, like this is babysitting a 2-year-old and this is, babysitting a 12-year-old, but it's babysitting. So as far as, let me see what that is. There we go. So getting to your question, and this is a lot of information, and so, but there's a reason I actually put it out there. And this is how you scale a venture firm, because you drive that up and you drive your dollars under management up. Or you could choose to not scale and just keep it the same level, and if you're going to make more money, it's because you're making more money because your investments are being more successful as you become more experienced and your network improves. But if you are an entrepreneur, you're entrepreneurs, you do not want to send your entrepreneurs, if you can avoid it, to a venture fund that is right here in its life cycle. Because what's happening? They're waiting to close this fund before they'll write a new check. Right? Or they've slowed down because they're waiting for the timing for a nice smooth handoff. So there are 2 things that happen in implying risk appetite with venture capitalists because of this cycle. Right here, they are really excited to take risk because nothing has gone bad yet, right? Nothing has failed, so it's all fair game. But if they're getting to here and they've had a bunch of stuff fail quickly or it's not going well, they're going to get very conservative with the last few deals that go into that fund because they need to hedge the risk. They're like, crap, I took all these big risks early and they failed. If I'm going to give money back to my LPs, I got to get more conservative, right? And it's not going to be as big a potential return if I adjust the risk in theory, but at least you'll not lose all their money, right? So you'll see them get more conservative here.
But on the other hand, there's the other side of the coin when you're pushed to make investments in a certain period of time. So sometimes it happens that they really need to make investments. So it's kind of like the other.
It's the other, but that's for a different reason, right? So what I'm talking about is I'm making investments at a relatively steady pace, right? But how risky are those investments, right? Am I only investing in companies with revenue because I'm here and all the stuff without revenue went out of business, so I'm going to go invest in some with revenue and expect that it's less risky? Or if I get to here and I don't have any big wins to talk about, because again, if you're going to go raise a new round of capital as an entrepreneur, if you're raising a new fund as a VC, you want to talk about your wins, right? This is why I deserve to get more money and ideally money at better terms, right? So you need to talk about big wins when you get here, which is the other funky incentive. Where if this fund had a bunch of risky stuff that didn't pan out, but the investor said, okay, we'll give you some more because we believe that was a fluke, they might be a little more conservative here to make sure they've got some successful exits to talk about for this fund. Because people sort of blink and say, okay, I'll give you a second chance, but people don't give you a third chance, right? So again, it adjusts risk profile. Now what you're talking about is what happens if the market sucks and I just don't want to make investments, right? And this is interesting. This is what we saw in like around 2009, 2010, right? And this, I have a slide that talks about trends, but I don't mind, I'll throw it in here. So, so basically, if you're in a down market and the VCs are like, oh my gosh, I don't want to invest right now, everything is, you know, going out, there's no follow-on capital, you know, there's lots of reasons I want to keep my money in. Because, oh, by the way, that clock that counts what's the return, like is it a 100% return, a 50% return your investors have received, the clock doesn't start ticking on that until you make the capital call. So if you stop making new investments and you aren't drawing down capital, you haven't started the clock ticking on if, you know, what the percentage return you gave your investors is, which is an interesting nuance of how those agreements work. But anyway, so 2009, 2010, everyone sits out of the market, right? Because it's, you know, hell in a handbasket, no one knows what's happening. But then they start getting to this point and they're like, oh crap, I have to have my new investments done, and they all flood the market to do investments. So we had this interesting experience doing seed investment where, you know, this is the down period, and we tell, and I know I told all of my entrepreneurs, all right, you need to get through to 2010, no matter what. Like, do not raise enough money to get to 2009. I don't care if it's 12 months, 24 months from now, get to 2010, because that's when all these funds need to spend their cash, right? And you can see when funds are raised, it's public information, right? So it's easy to see if someone's coming up and do they have a big portfolio or a small portfolio, how much do they need to invest before they kind of get to this, you know, they'll go past 3 years, they'll get to 4 years, but most funds that have raised, you know, it's not their first fund, it's like their 5th fund, they get kind of itchy, right? Like, because they need to demonstrate to the LPs that they're continuing to perform. So they'll get itchy in year 4 and place it all. So that absolutely happens. But it tends to be more market driven, market trend driven than the personal risk appetite driven on the investments that you are making. Does that make sense?
Yeah, well,
okay.
I would add that, you know, we face a different situation in emerging markets than you guys. Here you have, like, you know, enormous amount of good startups and so on. We are on the other side where we have more money than startups to invest in. So it's like the other problem.
Well, what happens for you is then you have this issue of the startups that are good quality startups, you know, they're the pretty girl at the dance, right? They're gonna have their choice of who to work with. And so then it becomes, and the startups, this is invisible to them, right? They don't know what terms the investor raised money at. They don't know if they're getting 20% carry or 10% or whatever. All they know is this someone who will be able to support me in the future? Will they be able to participate in my future rounds? You know, so I have, so for example, I have, you know, a company that has money from, just raised money with us and another investor, and it's a new fund, and it's like the 2nd investment in that fund. So I am super excited because I know that fund has lots of runway. They have a lot of cash they can continue to put into this company I just did with them. And it's one of the reasons I worked with them on this deal, right? And then I have another company that has a venture fund that's one of our syndicate partners, where it's one of their later investments, and we've done some pro rata because there's been an intermediate round, and I know they have no more cash for this company. They've scraped the bottom of the barrel of the reserves they had for follow-on, and so I'm looking at them, it's like, all right, I know you have no more cash, but you need to make, you know, you need to be transparent about that with the next new investor we bring in, because what a new investor wants, like, I don't like to talk to an entrepreneur and say, okay, so are your current investors doing pro rata? Are they all going to step up? And if the answer is no, that is a yellow flag, big time. I accept the yellow flag if it's because of a reserve fund timing issue, because I know that's how that works. But if I hear no for any of those investors, I do have a conversation with that investor to find out why not, and they need to tell me that that's timing is why, right? Because, you know, that's how that is, for better or worse. Although then I would probably say, okay, when you made this investment, how much did you reserve for follow-on? Like, you invested $2 million, how much did you reserve to do for the follow-on rounds? And they'll give me a number, and I have my own sounding board, and if the number sounds too low, I'll say, okay, it makes sense that you can't do more because you screwed up. You should have reserved more. But if they give me a number that's relatively high, then I'm going to go, oh, so this company has been spending a lot more money than you thought it would. Tell me about that, right? Because that sounds like an okay number. That should have carried you through all the future rounds of financing. Why was it not enough, right? So it's interesting. You sort of pull these little threads out, right? Yeah.
So, but then it sounds like it's all about like financial planning. What if investor just didn't have appropriate chemistry, let's say?
Well, that's a whole separate, yeah. And that certainly happens, right? And I've had those too. So when I have had, so I have one of my companies where there was an existing investor syndicate. We were the third institutional investor, and one of the previous investors had a change in the partnership. So the partner who had led that deal was no longer involved, like he was off, not doing venture capital anymore, right? And so there was no one who really cared about that. You know, he championed it internally, certainly, to get the deal approved at the time, but there wasn't anyone very excited about it, so they were just sitting on it like an egg, and I was like, that's not good enough for me. I like really active people around the board. I don't like the hands that do no work for my companies. So we actually worked out an arrangement where we would place them, and you know, they were very gracious about it, surprisingly gracious, but they're very active investors, so you know. But that does happen, and ideally you can have a gracious way of handling that, and I think the closer the network is, you know, so if this was a fund that never did deals with Intel Capital or never did deals with the other institution that was invested, that would have been a lot more difficult. But they cared about the goodwill, right, and our ability to continue doing deals together. So it happens. I mean, and generally what will happen in that case, if an entrepreneur, and that's different from the chemistry question you asked, but it's the same outcome, right? It's like, for some reason, there's been a disengagement of active support. And if there is a disengagement of active support, you need to replace it. You know, the company still needs investors on its side. You know, you can't just have people sitting around. So ideally, the other investors will help resolve that situation.
But you mean like there is no situation where you can leave this passive investor? You know, assuming, okay, well, it was in the past, he was active, not now, let's move forward.
Yeah, it depends on how much ownership they have. So if you, and this is a little bit of a rat hole, so I'm going to answer this and then we should take it offline. But if you have 100% of the equity and you've got, oh, I don't know, let's call 65% owned by management and 35% owned by outside investors, right? If you have someone who owns 15% of the company, say, I'm done, I'm out. And you say, okay, well, I need to replace this person. For someone else to come in, they're going to have a certain percentage of the company they want to own. And often it's a big number, right? Like a lot of Sandhill VCs, it's at least 18, maybe up to 25%, right? And so then you're saying, all right, so I've got to sell another 20% of my company that I didn't want to sell just so someone has enough of a stake in the business to care and to show up and do work, right? Because this other guy is just sitting, holding a place on the balance sheet and not doing anything to add value in exchange for that ownership, right? This is the, are you putting in more than money, right? And if you expected that that investor was going to be a passive investor, then that's fine. But if it was someone that you brought in specifically to be your active investor and then they just, you know, flake out on you, that's terrible, right? And again, it looks really bad. So if I find someone to invest in and I see that someone who's typically active is behaving passively, I'm concerned, it's a flag. But if it's someone I know is passive, then I don't care, because that was part of the deal, right? Does that answer the question? Okay. So that's this. Are there any other questions, sort of understanding this flow of cash and sort of what that means for people? Okay. So here's some qualifying questions that is totally appropriate to ask. And in fact, what is great, since you guys are all going to represent a bunch of early stage companies, if you know this, you can help your companies quite a bit, right? You should know which of the VCs coming to your demo days or that you're doing introductions for, which of them are in a position to invest because they have fresh capital. And so you can always see when they started. You can find that's public information. But you know, it's reasonable to just make your life easy and just ask someone and say, so, when did you close your last fund? And if it was 5 years ago, you might want to say, oh, when are you closing your next one? Or if it was a year ago, you say, that's great. And the other thing you can ask, so let's say someone says, oh, it was a few years ago. You say, oh, okay. You say, when was your last investment? And to sort of get a sense, like, and if it was 6 months ago, that's probably a sign they're holding tight because they're waiting for the new fund and the new fund's not closing. And it's a bad time to go waste your startup's time talking to these guys unless you want to use them as practice. I actually have recommended, that's one of the things I've recommended to the 500 guys. If there are folks that are basically kicking tires with entrepreneurs but not writing any checks, you know, and people know they're not writing checks, that is a great way to practice your pitch because it's sort of a low risk. Like, well, they're not giving anyone money, and if they don't give me money, like everyone knows they're not giving money. But I got to get in with an experienced investor and practice my pitch. Another thing to understand, and this is getting back to the expectation setting that people did with their LPs. So when you go raise money, if you say I'm going to raise $100 million, and I'll certainly, if you want to just see people taking pictures, make sure these get distributed. If someone goes out and raises $100 million, they're going to say, okay, I'm going to do this. I'm going to build a portfolio with 50 to 60 investments. My average check for the first one is going to be $500K. I'm going to reserve this much for follow-on. Like, you set all of these things out, right? And you say what categories, what segments they'll be in. So again, this is kind of your job. If you can do this for your companies, you should. Understand, what's that average investment size? You know, what segments are they investing in? How many boards is the average partner at that firm going to sit on? And understanding how the process works. Because it's all a little nuanced from firm to firm. And this is a good way to sort of, again, not waste your company's time. Because I don't know a single entrepreneur that likes to raise money. In fact, and most of them sort of, depending on, you know, which accelerator they're part of, they speak with either contempt or loathing or, you know, tolerance. It's one of those three. But it's never excitement. Woohoo, VCs, more VC coffees. So your job is to optimize low number of VC coffees with high dollars raised. And so hopefully these are all questions that no one would be offended by. There are other questions you can ask that people might be offended by, but these are all safe. Yeah, go ahead.
Would you be offended if an entrepreneur asked about other firms? Because I know that some VCs are a little bit competitive.
Yeah. I do get asked, and to me, I think that is a great way that is a great tell for an entrepreneur-friendly VC. An entrepreneur-friendly VC will always share who else would be good, because the entrepreneur-friendly VC is looking ahead and saying, who else should be in this deal? You know, who else should be here? Who else's hand should be at the board table with me making this company successful? And that might be driven by folks that just good personal relationship and those VCs work well together. It might be driven by, wow, those guys have relationships I don't have. Like, so yeah, you should definitely do it. And there are some that don't. But I think the ones that don't are playing a little too much defense. I think that if you have a competitive offer to a company, either in terms of who the partner on the deal is or the strategic value the firm can bring or so forth, I don't think it hurts to, you know, be honest about what's out there. It's kind of like if someone comes to pitch me and they say, oh, we don't have any competition, I automatically give them less credibility. Right? So I'm like, so if I'm buying, who else am I looking at? You know, and I expect people to ask me the same. Okay. Any other questions on this kind of stuff? On assessing fit for your companies?
You mentioned demo day. What is the value of the demo day that you see?
Yeah. So
isn't it better to work directly with these investors if you already know them?
Value of the demo day for who?
For the startup that you represent.
I think the value for the startup is that most VCs will form some judgment of, is this potentially interesting, within 5 minutes, right? And so I would rather my companies were able to have that 5 minutes in front of 50 to 100 VCs at once and filter it down than I sent them out on the road to go do 51-hour meetings. That is a lot of time that could be spent building product, right? And I'm assuming if you're putting a little cash into these companies, you don't want them to waste time either, right? It's all about not wasting time. And so this is, I'm not going to read this, it's a lot of words. But this is, again, the common practice. Most venture firms have the same diligence process. Like, we go find opportunities, like we read articles, we meet you at a conference, we see a product launch, things that sort of pique our interest. We get an introduction from someone. We'll do that. We'll go take a look against how it fits to not only our own investment parameters, but also sort of, okay, in a holistic way, do I think this is a good business? And then do I also think this is a fit for like the things we do? Not only because I told my LPs this is what I would do, but also because if I'm spent all this time, for example, building up a network in online advertising, I should probably leverage that to the best effect. So I don't ever want to give someone a check if my time is not also valuable, because then in theory, my company's not going to be as successful as one where I'm giving time and money, right? Term sheets, they are non-binding. You'd be surprised how many entrepreneurs don't realize that term sheets are non-binding. This is like an offer letter. This is, you can let that 30K that you put down in the house just disappears if you change your mind. Walk away from it. They are non-binding. The one thing that I would call out around term sheets is there are two approaches to term sheets that VCs take. And I believe it is important for entrepreneurs to know which one is true for the VC who is just giving you a term sheet. Some VCs will give you a term sheet saying, oh my God, I love this business. It is exactly what I'm looking for. Like, I think you guys are really onto something. And I'm going to do due diligence around this term sheet just to make sure everything I believe is true is actually true, right? I'm going to call your references, make sure you're not an axe murderer. I'm going to call your customers, make sure they actually are your customers, that kind of thing. Now, some people look at due diligence the other way, which is I use due diligence to make my decision, right? And so I'm going to do diligence after my term sheet, but I might change my mind. I might change the valuation. I might change, the structure, how much money you need to raise. I might change a lot of things based on my due diligence, and because I haven't decided yet. So it's important to know, is diligence happening after the term sheet? And if it is happening after the term sheet, is it the kind that forms a decision, or is it the kind that confirms a decision you've already made before the term sheet went out? Again, it's a nuance, but I've seen that go badly. And I think it's because people didn't understand what that due diligence after the term sheet was for. Again, closing, be upfront about expectations about what kind of support you can expect. Is it one partner sitting on your board? Are you getting benefits from the other partners in the firm? Are they going to be engaged with you, folks you can reach out to? I think this has been more interesting lately, so actually I should put it on the slide, is what kind of structural support the VC might be able to give you. A lot of funds, as they grow and they have more companies in the portfolio, you start to get some network effect. And then you also start to get some structural, like, can you do programmatic value, right? And so you certainly see this with accelerators, right? You have programmatic value because you simply can't spend one-on-one time with every single company over, like, especially once you're a few years in, right? It's impossible. So what's the programmatic value, or the value you've engendered inside the community because you set that framework up for the community to help each other, right? And that's something I actually think nowadays is super important. I think that's my last slide. Yeah, that's my last slide. Let me see if I go back to it. Oh, there's my baby. She's super cute. So, let's see. My baby used to like to call Nima. Yeah, well, she set the speed dial for Nima, and I was like, why am I always calling Nima? Not that I don't want to call you. Like, it was like weekly. Oh, she's 2. She's 2 now. All right. So the last slide I have, which I'll speak to as I go to it, is talking about some of the trends, and it's a little bit of a recap. So I'm a very simplistic girl at times. It's getting better. It's getting worse. So, depending on what you think, if you believe it is a growing funding market and you see more dollars being placed by venture capital into the market, some of the things you'll often see. People are going to write a bigger check. You are going to see the valuations go up. You are going to see those firms, they are placing more money, but often they may be getting a lower return percentage for that capital, which goes, again, back to as risk goes down, you know, so do your returns. And you get a little bit of a gold rush mentality. So you tend to get more copycat ideas and they turn into acqui-hires. You tend to get, you know, the bar for writing someone a check, it's a little lower. And then on the other hand, if you see the market's getting worse, it's pretty reversed. So I get more of a, I know I get more of a champion's mentality. And so in a shrinking market, I'm not going to invest in the third person to do the same idea unless it's truly different enough that it might actually count as a different idea. So you want really unique ideas, you want very strong teams, because not everyone's going to flip into an acqui-hire or something like that. Valuations are going to go down, check sizes are going to go down. Now the thing to remember, in either situation, that money has to be invested. This is going back to your question, right? Like, well, what happens, you hit year 3 or 4, you still have to place the money. So you might have to time it a little differently as a startup, but ultimately the cash is still there. It just, you know, the doors aren't open, right? So, anyway, so these are the trends, again, for your companies more so than you, but as you see the market being more on one side or the other, it might want to affect your processes for who you're bringing into your accelerators. You know, so for example, it's been a great market, and there are a lot of companies doing metrics and analytics. There are a lot of companies doing social marketing, right? And they're all going to do okay, or a lot of them will do okay. When the market is not as good, like you look at someone's portfolio and every deal was like this crazy mishmash of different things because people are looking for more uniqueness, more differentiation from investment to investment, because it doesn't make sense to throw down on just one segment. So that's the rest of what I have for prepared slides. I'm happy to, I think there's a couple more minutes left, I'm not sure.
Just a couple more.
Yeah, so if there's a couple more questions. Yeah.
I guess one of the biggest problems that all accelerators face today is the equity gap between accelerator and round 8. Venture capital, sequoias, etc. probably don't look at companies getting out of the accelerators because they're too young, don't have enough traction yet.
It's different. It depends. It's interesting. It depends on the firm and the partner, not just the firm. So, for example, Intel Capital is formally stage agnostic. I can tell you there are individual partners at Intel that would never do a seed stage deal. I'll do a bunch, right? Because I'm comfortable in that space. I'm comfortable managing effectively, like, because you don't engage in the same way. You have to pick out those things that really add value and just focus on those, right? You're not going to go to board meetings and you're not going to know every detail. You know, if you've put in on a party round from Y Combinator, you're not going to know every detail month to month of someone's business. So you have to figure out, how can I support this company in a way that doesn't require me to be soaked in what's going on, where the CEOs, you know, and I chat every week about what's going on with these guys on the team, and you know, and you can do it, but you have to be very disciplined about it, right? Or it will quickly get away from you. And so, and you can see, so for example, like George Zachary and Bill Ty at CRV, you know, Bill's moving on, but George is, you know, still doing it. They do a number of seed investments for CRV. Eric Chin at Crosslink does a number of seed investments. So you do see some of these larger funds have a partner or two who know how to, you know, keep a stable of children. But yeah, it definitely doesn't apply to the entire firm. And what I would tend to recommend to an entrepreneur is, if you do have a larger firm that wants to write you a check as part of a seed investment, and they are not taking a board seat because it's a node or, you know, for whatever reason, you might want to take a look at what programmatic value does that firm have. And if they haven't developed it yet, it might not be a good idea, because they're going to write you a check and then just be gone. It'll be a passive investment. But there are firms that have structured value that they can add whether or not they're on your board, right? And I think for those cases, I think it's actually fine. And in some cases, it's great, because then you have the big name, you know, attached, and you still get some value. And actually, this lady down here had a question.
So we've only got a couple of minutes.
Yeah, exactly. But
This may be a rabbit hole, so feel free to say never mind. But you said something about your process on one of the slides, and I think what you meant was the internal process.
yes, the internal, yeah, it was
right,
the...
So you have sort of the partner that may be...
You mean this one? Yeah, so this process, this is the this is the VC's internal process.
Because I was just wondering, so you have the partner that is championing a particular firm. What happens, how much does the company or the previous seed round investors have to do to shop it to whoever else in the firm is approving it?
Right.
Is that really...
You should never, ever choose to shop it to multiple partners inside a firm because it always pisses one of them off. Ever. So if, now, which is not to say that you might meet someone at a firm and they say, you know what, this isn't really my kind of deal, but I want to introduce you to my partner so-and-so. I mean, because they know what each other likes. I mean,
but they're each making their decisions individually, or once one of them likes it,
typically, again, common practice, not everyone. Common practice is company will go and meet with one guy, and that might be an associate, it might be a partner, whatever. Whoever that is, they say, wow, this is really exciting, hopefully. And if they think it's exciting, then you come back and you talk to a bunch of people at the same time. And if the bunch of people you meet with, it might be 2, it might be 5, think it's interesting, then you go to a partner meeting and pitch everyone at once, and then you get a decision. That's the typical process, and there are very few firms that don't follow that process. If they don't, it's because it's a very small firm or it's a very experienced partner that doesn't need anyone to sign off on their deals, but that's pretty uncommon. They're partnerships, right? So you need people to generally be in agreement that the partnership should be invested. And I think last question, unless you say it differently, but yeah.
I assume you saw many companies coming out of accelerators. Given a chance, what would you suggest to us to change in what we do with the companies?
Change what you do with the companies. I think that, and I have seen this done well and done poorly, I think that the best thing you can do is to figure out how to effectively leverage the community around your companies. That is the best thing you can do by far, because again, you will never be able to do it all. So you need the community of entrepreneurs to support each other so that the alumni who hopefully are becoming more successful can come back and support, so that the mentors that you have around your companies have very easy, structured ways. Because it's one thing to say, oh, I'm going to go mentor, and then you don't give me anything to do, so I don't do anything, right? Because I don't know what people need, I don't know who the companies are, and every 6 months it's a different set, and if you don't give me a ladder to climb, I'm just going to stay on the ground, right? So, so I think the most effective thing you can do is set that structure up, and make it effective for the folks that are, going through the program, and the folks outside the program. Sure.
Okay. Thank you so much, Christine. God, I could listen to you all day. It's been fabulous. Thank you so much.